How's it going? In this video, I'm going to solve the financial statements. So the income statement, the cash flow statement, the balance sheet with all of the schedules already solved. We're just going to go in this order. You're going to solve the schedules and you're going to plug it into the financial statements. Okay, so like I said, we have the revenue schedule, the cost schedule solved. So we're just going to go straight down and we get the other schedule solved. So I'm going to go straight down. So I'm going to do the income statement, the cash flow statement, the balance sheet. All right, the first thing I'm going to do is I'm going to do the totals in the bottom with these first, and then we'll plug it in and go into the actual schedules to do it. So to find net revenue, I'm going to do the gross revenue minus the freight. Go across, and then I'm going to plug in, well, revenue, where was that solved? That was solved. A lot of the income statements can be different areas, like the cost schedule, the depreciation, the interest or the debt and interest, the taxes, and the revenue. So we want to know where the gross revenue. That's going to be right above. That's going to be the revenue schedule. And I have that. That's what we solved, our projected years. Right below that was the freight and warehousing. So I'm just going to go down that way and then have it go across. We got the revenue part solved. Next is total cost. And total cost is we got the SG&A, and then we got the cost of sales. What I'm going to do first is I'm going to do the total. So I'm going to do all equal. So I'm going to sum up the total cost, drag that across. And then before I do the to plug in where the cost schedule is solved for the cost of sales, I'm gonna have to do the SG&A. And in the SG&A, we made an assumption. So the last recorded year is 3.8. We made an assumption that SG&A is going to cost us 3.9 million for that first projected year. So I'm going to plug that in. And then from that, we made the assumption that SG&A after the first projected year that we put in the assumption, we said that it's going to grow at the rate of inflation. So it's going to be the second projected year will be the previous projected year multiplied times. I'm going to bracket it 1 plus, and then I'm going to go up. Now this is important to make sure because we plugged in 22, 23 was the second projected year. So I want to make sure I get the cost inflation that is in 23. Now I plugged it in the cost schedule. I also have it in the revenue schedule, or you go to your scenario page, but you don't want to hit 22. You want to hit 23. That's important because we already made the assumption of what that would be in 22. So I'm going to drag that across. So we got the SG&A, and then all I have to do is plug down the cost of sales, and that was in the cost schedule. That was our total cost right there. I'll plug that in, and then that's gonna solve the cost part of the income statement. Next, what we want to know is we got our revenue, we got our total costs. I want to know what our EBITDA is. So I'm going to say equals. So I'm going to do the total down there first before I do the cost adjustment. I'm going to go to net revenue. I'm going to subtract out the total cost. And then if you noticed, the cost adjustment is either a gain or a loss. So if it's a loss, we would subtract it. And if it's gain, it'll be a positive, right? So I'm just going to plus that value. That's important because the cost above it is as a positive, but since this is a cost adjustment, it's a gain or a loss. That would be a positive or negative. So if it's negative, we don't want to hit a negative, which would make it a positive. So I'm just going to do plus that. So I'm going to have this go across, and this is going to be correct. And all we're going to do here is I'm going to add in from the assumption page, we made a assumption. Now this is important. In a case study, it may have it, but if you have something on the income statement that is not in the case study, you can make your own assumption. So you can say, you know what, on the income statement, cost adjustment is 0 for each year. So you can make that assumption. Okay, next is our EBIT, or I'm sorry, EBIT. So earnings before interest and taxes. Now all we're going to do is I'm going to go to the EBITDA, and then I'm going to subtract out the depreciation above it. So all we're doing is just subtracting the next line. And then I'm going to add in depreciation. Since I subtracted out depreciation, I want the depreciation as a positive because I'm subtracting it. And if you ever get confused, look at the last 3 recorded years. They have it as a positive, so keep it the same. So I'm going to go all the way down. I think it's important to do the arrows down so you don't accidentally hit the wrong year. And we're going to plug in our depreciation. Okay, we got the EBIT, and next is the earnings before taxes. This time I'm just going to drag in our interest expense. So I'm going to go all the way down to the interest expense, which is second to the last, our debt and interest schedule. At the very bottom is our net interest expense. In our example, we had 3 different expenses and 1 gain. We had our revolver, number 1, we had the fixed debt, long-term debt, and then we had the variable long-term debt. So those are 3 negatives. But how we put it as a positive number because we're going to subtract it. And then we had a cash value. If we had cash, we made money on the cash. So I'm going to put the interest going across. And then what I'm going to do down here to total it, to find the EBT, earnings before taxes, I'm going to go to the EBIT and I'm going to subtract out the interest. Now this doesn't look like it's correct yet. So everything that lights up green, of course, is correct. It's because we haven't solved the net income yet. Okay, next, let's plug in our taxes. This is going to be from the income tax revenue or the schedule. So I need current and deferred, and we're just going to add them both up. On our income statement, we break down both. Now, some will not break it down. They just want the total. In this example, we're going to have current plus deferred. How I set it up on the taxes, I have current right here. And then right below it, and it's real important when you set up your financial model, you want to make sure to make it easier. When I input these in, they're just right next to each other, so I can just drag it down after I selected that cell. Okay, now we want the total income taxes. So I'm going to alt equals that. I'm going to add up deferred plus current, and that's going to give us our total taxes. And then the next line we got is our net income. Our net income, what is it going to be? Well, it's going to be the last calculated field, which is EBT, earnings before taxes. And I'm going to subtract out our total income taxes. So deferred taxes is something I deferred out. Therefore, the income statement isn't analyzing how much cash I actually have. So it's assuming that that's a cost, even though I'm deferring it out. So the cash flow statement will have to add in the deferred taxes because we have not paid it. We deferred it at a later time. So that's going to be our income. Have to go across. And let's plug this into, we got preferred dividends. I got preferred dividends. That was calculated in the equity schedule. Preferred dividends is calculated there. So we're going to go all the way down there. So when you think about equity schedule, I think of preferred, common, retained earnings. We've got those 3. And if you ever get confused what is in the equity schedule, just go to the balance sheet. Go to the balance sheet and look what's listed there. Preferred, common, and retained earnings. So what I want is our preferred dividend. I'm going to have this as a positive value. So I'm going to select that. I'm not going to put a negative sign. So a lot of the income statement, we just has positive or net. We just keep it positive and we subtract it. So there's the dividends. I'm going to have it go across, which is correct. And now we want to know what is the net income to the common shareholder, because it's almost guaranteed to the preferred shareholder. They're going to get it, their dividends, even if we lose money. But we want to know how much of the net income is going to the common. So what we're going to do is we're going to take the net income and I'm going to subtract out the preferred dividend. I'll have that go across. Okay, so the income statement is solved. As you can see, it's not all green, so these numbers are not correct, even though we have solved it. So if I go to the grade, um, the income statement is almost solved, and I forgot one part, which was our sales volume. I include that up there. And that's important for the working capital schedule. So I'm going to go up. Where do we solve our quantity? That's in the revenue schedule. And we have the annual sales volume. So I'm going to plug that in. And that should give us our almost 100%. I think I just have to scroll over one. And then we got 100% on our income statement. Now, this is kind of cool to look at here. We got 100% completed, as in I did the equations correct. Those are correct. But our income statement grade, which means only 80% has correct numbers. And you can see by the green cells that we are missing these is because net income, we have to do a few more things to get these to be correct. Next is cash flow statement. I recommend, again, go to the totals down there. Now, if you had a financial model, typically these would already be solved. Down here, you just could drag it across, but I'm going to total that. We're just going to sum up all the operating activities. Now let's look at what we have here. Number one is net income. Now, some people get confused by this because we got net income to common, and then we got net income before we took out the the preferred stock. Now, with the cash flow statement, what I want the net income, not the net income to the common shareholders. I just want the net income. And then next, that's how much money we made. So we wanted to find out how much cash we have. So next I have to do, because we subtracted out depreciation on the income statement, right? So that 37.3 isn't the cash we have because depreciation wasn't a direct outlay of cash. So what I'm going to do is go down to the depreciation schedule and I'm going to add it back in. Next is our deferred income tax, right? We subtracted all taxes away from there. However, deferred is deferred out. We still have that money. So to find out how much cash we have, I'm going to add back in the deferred taxes. So I'm going to go down there. You could go to the income statement, just drag that in. But I'm going to go directly to the schedule. And then we got change in working capital. What is that? That's changes of inventory, accounts payable, accounts receivable. There's other parts of that. But really what it is, it's current liabilities and current assets, but not cash. So the current, so I'm going to go down the balance sheet show real quick. So if you look at the balance sheet here, it's not cash. So we're not going to include that. So what does that entail? What is the change accounts receivable, inventory, prepaid expenses, and other? All four of those has an impact on cash. If it's going up, our cash is going down. If this is going down, our cash is going up. And then we look at liabilities. It's not the revolver, but it is the accounts payable and the other. And what is that? So it's right here. We haven't plugged it in yet. These two. So if liabilities goes up, our cash goes up, right? If you get a loan today, I have more money today, even though I owe it tomorrow. So if I got $1 million loan today, I'm $1 million more wealthy with cash. So we're going to go all the way down to the working capital schedule. On the bottom in there is the change in working capital. And this is what we want to plug in. So it's real important to drag it down and make sure you got the correct year. I got all four of those. So what I'm going to do is highlight those and drag those over. Again, Everything is correct besides net income because we got to plug a few more things in. So that's the operations. We want to know how much cash we have from operations. Next, I want to know how much cash I have from investing activities. So we got, and now with the cash flow statement, we want things as a positive, as an inflow, and negative as an outflow. That's real important. Income statement, I didn't show costs like that. Cash flow statement, because we're going to sum up the bottom. So I want to know, what is our cap X? What is our cap X? Well, I'm going to go to the assumptions. Our capital expenditure is right here, right? I'm going to put a negative on there because I want that to show what's that going to cost. We're buying capital expenditures. I'm buying more, which is going to cost money. That's a negative, right? That's a negative cash going out. And then we got other. We got other here. I go to our cash flow. This is an assumption we made. Again, if this is not in the case study, right, and you find this on the cash flow statement, you can make your own assumption. Make the assumption. You could say we are investing activities is $1. You could say if you wanted to, but I'm just going to say 0. And then what we're going to do is sum that up. Well, you can think about whatever the quickest way is to get those solved. Can that ever be positive? Yes, that could be positive. We have a bunch of capital and we're selling it. If I have a lot of um, investments in or property, plant, and equipment, and I sell it, that will be a positive capex that we're selling. But since we're buying it, it's a negative on the cash flow. Okay, next is our financing. So this is real important. If you look at financing, revolver, variable debt, fixed debt, that is from the debt schedule. And we got our repayment plan, or the issuance of it. We want to know, are we getting more debt, or are we buying, are we repaying our debt? We want to know. So it's all the debt schedule, and then we got on the bottom part we have is dividends, and that's going to be our equity schedule. So debt schedule, equity schedule, plus a lot of this is found in our assumptions. We had to make those assumptions when we solve those. So you kind of want to go through a quick way of doing this, but the first one is a revolver. So I'm going to think right away, well, that's going to be by itself. That's the debt schedule. This is a financing activity. This is cash flow. So this is the change of, this is not a balance of some sort. So you got to know, are you going to add more? Are you taking away from this account? So when we go down to the debt schedule, you want to think about is where. So here's a revolver. To find the revolver, we had to add up the cash. We had to add up all the cash we had for the year from operation and investing and our automatic debt repayment and our dividends. We want to know, how much money do we have left over? In other words, what is our free cash flow after mandatory debt repayment and dividends? Then we may use the revolver. Okay. In the revolver, I have the beginning balance. I have the addition or repayment, the change of it, and I have the ending balance. So cash flow statement is going to be the change. So I'm going to select the additions, the repayment part of the debt schedule. Next is our variable debt. Now, this is in our assumptions page. If you look at it, I put this in order just like the order on the cash flow statement. I have variable debt, fixed debt, and this is all for issuance or buyback or repayment of debt or buyback of stock. So I have all 4 of those in a row. And if you notice on the cash flow statement, they're all in a row. So that would be a very quick way of just to sum those up. Or I'm not sum those up, but to just drag it down real quick so you don't really have to think about it. And those are going to be a positive or negative on the assumptions. If we're buying it back, it's going to be a negative because it takes cash away. And that should be just, we don't have to put a minus sign. It should just automatically do it. And then on the bottom here is we want to know paying dividends is part of our investment because to raise funds, we have to issue preferred stock. Therefore, we have to, part of the cost to issue preferred stock, excuse me, is the dividends we have to pay for it. So I'm going to go equals, and this is if we're paying a dividend, it's going to be a negative. But I'm going to go all the way down to the equity schedule. And what I wanted to show you is there's two ways of doing this. You could go, here's the schedule here. We have the dividends paid here. Now, if I selected this one, it's going to automatically just select that. Then I have to select the next one to go to common. Now, what's easier is and you have to put a minus sign. If I go down to retained earnings to find out our retained earnings, well, I do the preferred dividend and the common dividend right next to each other, and there's a minus sign next to it. So what I'm going to do here is I'm going to select this. Okay. So in the retained earnings, that's how we selected it. We made sure if it's an outflow, we put a negative there, and they're right on top of each other, preferred and common. And if you look here, right, preferred is on top, which means all I have to do is drag it down to get the common, and we're all set. So that's the financing activity. And what I'm going to do is I'm going to sum up all those. I'll just drag it up to that point, because typically you're going to already have it solved there from the previous actual numbers. And then this should go across. I don't know if the revolver will, yeah, the revolver is correct. The only thing is not correct is common dividends. And you ask the question why? It's because common dividends has to do with net income. Net income is not correct yet. Preferred stock does not have to do with net income because you pay the preferred stock no matter what. So this is how, of course, this is how it looks. And then we want to know the cash summary down here. So the first part is what is the change of cash per year? Well, the change of cash is going to be the financing activities. I want to know what that is as a negative. Plus, I'm going to go to the investing activities, negative. Plus, I'm going to go to the operations. So that is our change in cash. The beginning cash balance, this is going to be given. This is the last year. This is not something we could solve. We have to know the beginning cash balance is the ending cash from the previous year. Okay. So just to show this real, well, I won't do that right now. I'll do it in a second. So we got the change of cash. I got the beginning cash. Therefore, I want to know my ending cash. So all that's going to be is a sum of those, the change in cash plus the ending cash. So if I drag that across, just to show something real quick. So how do I find out the beginning cash for each year? Where the beginning cash is going to be the end of the previous year. So the ending balance will become the beginning, right? So it's the change in cash plus the beginning, which was the ending, and then you sum those up to get the ending for that projected year. And now I can just go across. Now the cash flow statement's all solved. Everything is green. If I look at everything solved, 100%. Income statement, 100%. The only thing that's left is the balance sheet. Okay, so we got the balance sheet. So we want to do is I'm going to do the same thing. I'm going to sum up those totals in the bottom, which is just our current assets. I'll bring those across. And again, I'm going to remind her for the working capital schedule. The first one is cash, which is not part of the working capital schedule. And then the four ones underneath it is, which means this is part of operations, working capital, which is going to be if they go up, our cash goes down. If they go down, our cash goes up. Now, if it doesn't make sense, think about inventory. If you buy more inventory goes up, but you had to use cash. You're going to lose cash. If you sell off your inventory, you don't have that much inventory, you'll have more. So it's inversely related. So the first thing we're going to do is we're going to add in cash. How much cash do we have? Well, that's going to be our ending balance on the cash flow statement. That's the ending balance. Now I want to know the balances for the accounts receivable, inventory, prepaid expenses, and other. That was solved in the working capital schedule. Now this is very important to do. When we look at the working capital, I got the days in, how long it took to collect, or the percentage average, how many days are they in there. What I want is the account balances. The first thing listed is accounts receivable, and they are in order with the balance sheet. Accounts receivable, inventory, prepaid expenses, and other. So if I select that year, that means all I have to do is go down and they're all solved. So I'm gonna highlight those, go highlight to and hit Control R, and we just filled in the balance sheet. Okay, let's do the long-term assets. We want to find out, again, this is a balance. This is the total amount. So how do we find out the total amount of net PP&E, property, plant, and equipment? What we're going to do is I'm going to say it's the previous amount, right? I'm going to add that in. Now I want to know what changed. So what I'm going to do is I'm going to add in our capital expenditure. So we're adding to the long-term assets. And then I'm going to subtract out depreciation. Oh, did I pass it? I'm going to subtract out depreciation. Depreciation is how much is depreciating our long-term capital expenditure. So that's going to be our total net PP&E. Next is other. What is other going to be? Well, it's going to be the previous plus we have an assumption of our cash flow, our investing activities. Well, we just made the assumption as 0. And now I'm going to sum those up. Drag it to the right. So I'm going to highlight those 3, and that should be solved. All right, next is liabilities and equity. So we got our short-term or current liabilities. Again, on the bottom is just a sum of those. I'm just going to bring it over to that first projected year. And what we want to do here is what we have. Just like the current assets, the first one is solved. The first one for assets is cash. That is found in the cash flow statement. This one is the revolver. This is the debt schedule. And underneath that is the working capital totals. So what I'm going to do is find out what is our balance. This is the balance sheet. I want to know the balance of the revolver. When we did the revolver for the cash flow, that was a change of, right? How much did we add or take, or we paid off, or we added to the debt? And now what I want to know is what is the total. So here's the addition, what we did to the cash flow statement. Underneath is the ending balance of our revolver. That's going to go into the balance sheet. And then next we got accounts payable and other. That is going to be located on the working capital. So those are going to be the last 2, the 19.1 and the 4.8. I'm going to drag it down again. They're going to be right next to each other. Just we're going to have the balance sheet. That's how we're going to situate our working capital. Okay, that's solved. Next, we want to know, what about our long-term debt? What's our long-term debt? So I'm going to hit all equals. We'll solve those up to the first projected year. And then we want to know, what is our long-term deferred income taxes? This is a balance. So what is our preferred income tax? Well, it's the previous deferred income tax is the previous year plus the increase or decrease of it. And that's found in the income tax schedule. That's the increase or decrease of deferred. Next is, what is our total, our balances for variable debt and fixed debt? Well, that's going to be on the debt schedule. So I'm going to go all the way down to the debt schedule. And what we have here, I got the variable. I'm going to look for the ending balance. So it's always important. You want the ending balance for most all things balance sheet. So back to the debt schedule. Now I want the fixed debt. Where is the ending? Got those solved. Okay, next, I forgot to do this. We have to add up the total assets. What is total assets? Well, it's the current assets plus the long-term assets. We'll have that go across. Next, I want to total up the total liabilities. Well, that's going to be the long-term debt plus the current liabilities, short-term. I think my green cell might be I forgot to turn that part up. Yeah, I forgot to turn it on. All right, now we can add up the total shareholder equity. I'm gonna go to the first projected year, sum those up. And what do we have here? I have preferred shares. I want to know my total balance of preferred shares. So I am going to go all the way down to our total balance for preferred. That's in the equity schedule. Next, I want to know the total balance for common. Next is what is my total balance? So equity is easy. That's in the equity schedule. Preferred, common, retained earnings are all found in the equity schedule. I always want the ending balance. That's one of the purposes of the equity schedule to find out how much we have. And there's our ending for retained earnings. We got all those. So I'm going to drag that across. That is correct. And next, what I want to do is add up our total liabilities plus equity. There's the total liabilities. Here's total liabilities, and there's the equity. Add that up, have that go across our balance sheet balances. And just to make sure that looks correct, I'm going to go to the grade sheet. We're 100%, 100%. Everything looks good. There you go. And just let you know, if you want to redo it and practice, hit that reset button. Oh, I can't. I said hit it and it doesn't work. Sometimes you have to, okay, you have to save that file for it to work. And I just downloaded it off our website, off of Blackboard. There you go. Any questions, please let me know. You have a great day and send me an email if you have any questions.